Nic Norman-Smith from Lentus Asset Management joins us in the studio. Nic, always a pleasure having you on the desk with us. We're talking retailers this evening and why you believe the retailers on the local front are overvalued. One premise that you have put forward off air is that there are very low barriers to entry in the industry. I'm going to ask you to qualify that statement.
Sure, Bronwyn. So when investing in any business, you want to look at what kind of barriers to entry, and why that's so important is that if there are high barriers to entry, there's going to be low competition. Low competition means you can charge higher prices and make fatter margins. So ideally you want to be in businesses that have very high barriers to entry, such as tobacco companies, because you can't launch a new cigarette company because you can't advertise. Highly regulated businesses, casinos you were talking about earlier, that sort of thing. Now, it's not that you don't mind investing in a business that maybe has lower barriers to entry, but if it does, you need to pay quite a cheap price for it, because what we've seen over the last 10 years in South African retailers have been phenomenal. They're some of the best managed businesses in the world. Some of the highest returns on equity, some of the highest margins. They've had massive tailwinds in terms of emerging market consumers. We know the whole story. But you've now got to the point where these retailers, most of them are on peak or close to peak earnings, peak returns on equity, margins, etc., significantly above anywhere else in the world. And what that's going to do is attract competition. And we've seen it already. The world's biggest retailer, Walmart, has come in and bought Massmart. And they're not doing that because they think they're going to make a poor return. They can say, hang on, here's an industry where we can make a heck of a lot more than we're making in the States and everywhere else. So, and the way these retailers are priced, most of them, is they're priced to continue generating such phenomenal margins. Now, they may do that. We can't predict the future. But the downside risk is quite serious.
Let's bring you into this discussion here.
How about the argument that says something in reverse? In other words, it says that if you've got a company that's got a high barrier to entry, yes, it can charge a higher margin, but because of the lack of competition, it potentially becomes lazy. It becomes inefficient. It doesn't work its balance sheet as aggressively. And so it's charging a higher margin, but not necessarily producing a fantastic return to the shareholder simply because it's internally inefficient or its balance sheet is lazy. You take retailers in South Africa, they've got a lot of competition, they're very efficient, as you've said, they're very well managed, and they work that balance sheet. And as a result, they generate a good return, and therefore the shareholder is willing to pay up for that. They're paying up for the efficiency, for the productivity of the company. Does that make any sense?
Yeah, there certainly is some merit, but you know, let's look at Massmart.
Some merit. It goes with some merit.
You know, look at a company like Massmart. Massmart traditionally is traded on a price to book of probably around 4 or 5, probably even lower in the early 2000s. It's now trading on a price to book of 8 or 9. It's trading on an earnings multiple, if you strip out the acquisition costs, of over 25. So yes, they've done well, and sure, it might push management, but let's go back to someone like a British American Tobacco. They have probably been quite lazy, and there is the investment thesis. They can cut a lot of costs, because there's not a lot of growth in the tobacco industry, and there's lots of regulation and lots of other bad news, but there's a large scope to cut some costs. You were chatting about Amplatz earlier, exactly the same thing. There's scope to cut costs. So rather buy when the news is bad and the company is not doing so well, because your upside potential is so much higher. Rather than buying.
Is there any value, in your opinion, in the retail space? Do you have exposure to any of these stocks?
We don't at the moment. We used to hold Massmart, and we said quite happily, thank you, Walmart, we'll take your money.
You take your money and run.
But we don't at the moment, but a company like JD Group is something that is on our radar and we're looking at quite substantially. It's got a debtors book, which was in horrendous nick. They extended credit inefficiently and poorly over the boom periods. That book's been cleaned up quite a lot. And management have got it right. They've centralized credit collection. The share price has gone like this. If you pull up a graph, you'll see JD Group's share price looks horrendous. So they've actually got a debtors book which is now in better shape than it's probably been in a number of years. And the market is virtually valuing the retail business at maybe R1 billion. So the debtors book.
On your radar screen, have you bought it?
We haven't bought it yet. But
Kevin, what's your exposure on the retail front?
No, actually, we have a fairly high exposure to the retail sector.
Which is why you were trying to put a different investment
case
on the table.
No. Look, it's been a good investment. Let's face it, the retail shares have done well. It's not been a bad investment. What
But
concerns
when do you let go?
Yeah. So what concerns me is not so much the barrier to entry thing. I buy the argument. Fundamentally, there is an argument around barrier to entry. But another counter argument to the first counter argument is that it's not exactly that we've got companies rushing into our retail. We've got Walmart, and then we've got Walmart. So it's not as if there's a lot of guys. So I think that the problem for retails is not so much that companies rush in and compete. It's that the fundamentals of the economy start to move against it. And consumer is under enormous pressure. Consumer disposable income's under pressure. They're not going to be able to devote as much money to general retail because they're paying for electricity, for petrol, all of these things. And it's that reason why retailers start to then become expensive rather than because if I'm going to follow Nic's view, then I'm never going to buy a retailer because they've always got low barriers to entry. There will be times to buy retailers.
No, but let me clarify. What I'm saying is I would be willing to pay a premium price for a company with very high barriers to entry. If it doesn't, like these retailers, then I want to pay a cheap price. I want to pay somewhere close to a JD Group's price, or I want to pay where Truworths and Foschini and all these other businesses were trading in 2001, 2002. But so there's a number of things. There's the risks of possible slowdown in the economy. You add them all up together and they all say, look, I'm just a little bit concerned.
What about the international investor interest in our retailers? Because that is one reason put forward for the fact that the share prices have rallied so hard. And the second part to that argument is that we are cheap in the South African retail space compared to retailers in other emerging markets, and that's going to continue to fuel that international demand for them.
Yeah, it's a good point, and we've never at Lentus bought this whole relative valuation argument. If something's expensive and something slightly less expensive, it's still expensive. So we'd much rather buy something that's absolutely cheap. You know, we're not a hedge fund. We don't go long short and wait for that gap to close. So yes, the investor interest may come internationally for a long time to come because people don't seem to like all the great value opportunities.
And continue to blow those valuations out of the water.
Yeah, but we'd rather sit on the sidelines and wait till maybe it forms a bubble and it bursts at some point and we can buy that back. You know, we'd rather buy in areas that people like a lot less.
Nic, what would you be buying now then? What for you has a high barrier to entry and you're willing to go into it under current circumstances?
You took the words out of my mouth.
Most of the stocks that we're buying, and certainly the more high quality stocks, are offshore. So you were chatting about tech stocks earlier. We own quite a lot of tech stocks, Microsoft, Intel, Cisco, all very high barriers to entry for various reasons. They all have some stories on why they're not great investments, but we think those are overdone and more than in the price. Dell we own, it doesn't have as many high barriers to entries, but it's got some other characteristics that we like in terms of how it can manage its working capital. Johnson & Johnson,
so also very much in the
companies.
Offshore space, a very similar theme to Linda Eads and RCM. We were just chatting to Linda a moment ago.
Yeah, we think that this is a massive opportunity that I don't know when will come around again, where we've had a very strong currency and international equities are very, very cheap. So a company like Vodafone, no one really likes it because it's done poorly over the last 10 years. It's got massive exposure to Germany and Europe. But it's trading on a 6-7% dividend yield if you count the special dividend that's coming. It's trading on a price to free cash flow of 10. All of these businesses are priced for failure. Coca-Cola, great brand. There's a barrier to entry and a distribution system. It's got a bit expensive now, but you could have bought it over the last couple of years, which we have quite aggressively. And so there's so many high-quality companies that people seem to have shunned, rather than, so it's a very interesting space. Whereas locally, there are one or two businesses that are quite attractively priced, but on the whole, there's a lot more opportunity.
That means
offshore.
then you're heavily skewed to offshore at the moment.
Yeah, no, we are. I mean, we're probably around half in terms of where our capital is locally and internationally. Internationally, we're probably around 80% deployed. We bought probably another 20% client exposure in early August when the market took a big hammering. So whereas locally we're probably only 30-35% deployed in equities and sitting along a lot of cash.
One more quick question to you.
Quickly, Nic, you like the tech stock or some of the tech stocks internationally, and I can understand the merits around that, and I would agree with that. Local tech stocks, there's not a lot of them, but would you be looking at them?
it's an industry that is quite tough because generally there aren't actually too many barriers to entry in tech stocks. The only ones that we feel you really get are in some of these massive ones that have the scale. Given the relative valuations and the opportunity to buy something like an Intel or a Cisco at such attractive valuations, why bother looking at anything else?